The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 at Bloomberg headquarters in New York, Romaine Bostick here with The Close, kicking you off to the closing bells here in New York, just 10 minutes away and just a little more than an hour removed from the U.S. Federal Open Market Committee voting 11-1 to cut the target rate for the federal funds rate by 1/4 percentage point to 4% to 4.25%. This after holding rates steady for 5 straight meetings this year. The initial market reaction to the 2 p.m. Fed statement was a bit of a risk-on rally that briefly pushed the Russell 2000 above an all-time high that it hasn't broken since 2021. Rate-sensitive assets like banks, like home builders, like gold all pushed higher as well, though they did reverse some of those gains, yields, crypto, and the dollar dipping. But once Jay Powell got to the press conference and outlined the potential risk ahead and the tension between its 2 mandates in bolstering the labor market while tamping down inflation, the price action flipped a bit. Jay Powell trying to explain, well, I'll just let him explain it himself.
In support of our goals and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by 1/4 percentage point. The labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, I can no longer say that. We did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. I think you could think of this in a way as a risk management cut. Inflation, we continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass-through of the tariffs into inflation has been slower and smaller.
Jay Powell was the man of the hour as we kick you off to the close. Ken Shinoda joins us here in Studio 2, portfolio manager at DoubleLine Capital. And Ken, I want to focus first on the use of the word risk management, the phrase risk management, as a way to characterize what happened today. What do you think he meant by that?
Yeah, I was really keen on that word because the bulls were hoping for more dovish language out of him. The bears, maybe those who wanted to short bonds, were hoping for some hawkish rhetoric. And I think he picked that risk management word because this is a cut, but we don't know what's going to come as far as the data, and we need to go meeting by meeting and be data dependent. So he's keeping that data dependent way that the Fed has been acting.
Are you surprised by that?
I think that he does not want to make the mistakes that other Fed chairmen have made in the past by cutting too soon, and so he's really keen on keeping rates where they are, staying restrictive until he's really sure that the inflation is contained. But he's definitely concerned about the labor market. We've had some weaker non-farm payrolls, and that's what he was focusing on at the end there.
Well, in your role in the money you manage, and more particularly the types of assets you manage, what's more of a concern for you right now, the labor market or inflation?
For credit-sensitive assets, then we're really focused on the labor market if we're heading into a recession. But company earnings are strong. Retail sales came in decent. And so the credit markets aren't really worried about it now. I think I'm more concerned about the long end of the yield curve. It's had a decent rally here. But, if we go back to concerns around too much fiscal stimulus, excess spending by the government, I think that long end could steepen more. So I'm more convinced that if things weaken, the 2-year will fall in yield. Then I'm convinced that the long bond will have a huge rally.
What is that balance right now? Because, he didn't talk a whole lot about that and really wasn't asked about it, to be fair. But there has been this positioning in the market that has pretty much been short duration or at least medium term duration, and not a whole lot going on the long end of the curve other than for those institutions that basically have a mandate to buy out there.
Well, it's been a good place to be. T-bill rates have been really high. The 2-year was a few weeks ago closer to 4%. You could buy some credit assets on the front of the curve. So look, I still like that front end of the curve. We've had a little bit of a rally here that maybe we could see a pullback. I hate to read too much into price action on Fed Day because there's so many people that are changing the positioning. But I think if you get a little bit of a pullback across the curve, it's good time to add. You don't need to add the long bond, but I feel like a broken record. I've been on here for the last couple of years saying that like kind of 2 to 5 year portion of the curve, it's a good place to be.
I am curious what the net effect, let's assume for a second this is the start of an actual rate cutting cycle and not just a one-off. They've promised, or at least the dot plot promises, 2 more cuts this year, maybe 1 in 2026. with regards to the housing market, we saw housing stocks today get a little bit of a boost. Some bank stocks also getting a bit of a boost. For mortgage traders, mortgage bond traders here, is that going to be a net positive, or is this something now that you have to kind of hedge?
Cutting rates is definitely net positive for investors that buy agency mortgage-backed securities. The spread that you get paid is highly correlated with interest rate volatility. So when bond prices are going down, rate volatility is going up. That's a really bad market for agency MBS, and we saw that through kind of like 2021 on through the middle of 2023. But as they cut rates and rate volatility comes down, that's a really good market for government-guaranteed agency mortgage-backed securities. You mentioned the housing market. The challenge the housing market has is, let's just say the neutral rate is 3, and the Fed cuts all the way to that through the end of next year. You know, will the 10-year, the mortgage rates that you as a borrower get out there in America, it's really tied off the 10-year portion of the curve. Yep. Are we really going to see lower 10-year Treasury yields than 4%? I think you might need to see a recession or a big slowdown in growth to really break down and get down towards that kind of mid-3s.
Are you anticipating that we will see, I guess, if not in a recession, more economic pain in the short run or medium run?
It's hard to say. We're all watching the data. One of the things that we're noodling on, and Jerome mentioned that he's looking at the payroll numbers because they used to come in.
You're on a first-name basis with him?
I hope so.
Okay.
I feel like he's a nice guy. Payroll numbers have been coming in, 100 to 150,000, and now they're coming in, and I think Powell referenced kind of that 0 to 50,000 range, and so people are concerned. Now, things have changed. We've seen a big demographic shift. Baby boomers leaving the workforce. Immigration's down a lot. So maybe a lower non-farm payrolls number, maybe that's the new normal, right? And so really, we should be more keen on the unemployment number as opposed to just focusing on job creation.
Is 3% inflation the new normal as well? Because we've basically been camped out there, at least on the PCE. Core PCE.
We're there right now. Goods inflation came up a little bit, and and he even mentioned that he's watching that. But it seems like so far companies have been eating a lot of that inflation and not passing it through. And I don't think if we see it in the next couple of months, I think that tariff inflation isn't going to be as bad as people thought. Yeah, that seemed to be a big takeaway, and he even addressed that during the press conference. The idea that a lot of that is sort of getting sucked out by the middlemen, and at least for right now, that's good for the economy. Ken, I have to leave it there. Always a pleasure. All right, thank you. Ken Shinoda, portfolio manager over at DoubleLine Capital. As we continue to count you down to the closing bells, a little bit earlier, we had a pretty strong rally on our hand where it looked like most of the major indices were going to set new record highs. As it stands right now, it looks like we are going to miss that. The Dow Jones Industrial Average up about a 0.5 percentage point on the day, and that is pretty much your outperformer. Everything else either flat or in the red. Yield slightly down, a mixed bag for the dollar and the VIX. The full breakdown of all of today's market action and a push ahead to what to expect next with our global simulcast that starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here to take you through to the closing bell with the global simulcast. It starts right now. Carol Massar and Tim Stenovic in the radio booth. Welcome to our audiences across all of our Bloomberg platforms. Here on a Fed day, Carol and Tim, where we got pretty much exactly what the market had expected, though the market reaction maybe not quite what some were anticipating. Yeah, we were just spending a lot of time talking about that with Megan Horniman, Chief Investment Officer at Verdence Capital Advisors. They've got about $4 billion in assets under management. Kind of interesting, and maybe now it's up to the markets. If the Fed is concerned about inflation, then certainly you're going to see that play out in the Treasury trade. She is concerned that the Fed is focusing too much on the labor market versus the inflation pressures that they laid out once again that are still in existence. You know, the excitement that I think we saw in the markets right when the dot plot came out, right when the rate cut came out, and before we heard from Jay Powell, I think it made sense. But then if you think about it from the perspective of, okay, what has this Fed chair done throughout his 1.5 terms so far? He said, we're data dependent, we're going to go meeting to meeting. So of course he's not going to be able to be confident about the rate path, when there's so much data that we're going to get even between now and the end of October. And this has pretty much been in line with the way Jerome Powell has sort of conducted policy pretty much since, we should point out, Trump appointed him way back when. And this sort of methodical, keep an eye on the data. It's a big part of the reason why they paused those rate cuts in January, because they wanted to take a look. He said it specifically at what the impact of tariffs and trade policy and Trump policies would be on the economy. And he addressed that today and basically said, at least for right now, that impact is relatively contained.
Yeah, saying not incredibly obvious what the Fed should do now. So they, too, are in a little bit of a pickle, right?
Interesting day in equity markets. We should point out that when that 2 p.m. statement came out, we did see markets push incredibly higher. The Russell 2000 at one point actually did trade above its record high for the first time since 2021, but it's not going to close anywhere near that. The Dow Jones Industrial Average is going to finish the day in the green, up about 260 points or 0.6%. The S&P down about 0.1%, closing right around that 6,600 level. The NASDAQ Composite and NASDAQ 100 each lower by about 2 to 0.3%. And the Russell 2000 is maintaining some of its gains on the day, higher by 4 points or 0.2%. But we should point out at one point, Carol, it was up a full 2 percentage points.
Got to say, we were thinking about you. We know you like to talk about that index and just kind of watching the move, but certainly a little bit different by the end of the day. Hey, S&P 500 guys, I know you're going to get into the industry groups there, Romain, but you did have about 288 names actually gaining on this Fed Wednesday, 213 to the downside, 2 unchanged.
Yeah, and it's kind of interesting, though. I mean, you talk about how do you get 288 names, the majority of the names in the S&P rallying, yet it finishes in the red. Well, a big part of the reason is, well, tech was pretty much at the bottom of that list. As a sector, it was the worst performing of the 11 sectors out there. Your leaders, though, on the day were a lot of the interest rate sensitive sectors, including financials. They were your gainers here on the day. Utilities also getting a pretty strong bid as well.
Yeah, that's a lot of red there, right? When you really kind of break it down in that way. Hey, listen, let's get to some of the individual gainers. Workday, this was a standout in both the S&P 500 and the NASDAQ 100. At one point, let me just see, up about 10%, almost 10% at its highs of the session, finishing though still with about a gain of about 7.25%. Company's board authorized a buyback of up to an additional $4 billion worth of shares. And also you had Elliott Investment Management unveiling a $2 billion plus investment in the company. The activist investor saying the company's CEO and his team have made substantial progress in recent years, driving growth and customer retention. They put out a statement yesterday. So investors moving into that one.
And did you take a look at just kind of the long-term chart on this? I mean, just really one of the biggest laggards in this space that we've seen.
No, I know. You're right. A long-term perspective always important on this one, but to see some investor momentum at this point, but that's what an activist investor will do. We'll get investors to take a second look. Hey, Baidu, also an outperformer, finishing pretty much at its best levels of the session. I'm looking at the ADRs, ticker BIDU, finishing up more than 11% in today's session. It is China's largest search engine operator. Overnight, I should point out, shares jumped in Asia, the most in over 2 years, and analysts upgrading the company, citing the growth potential for its in-house chip business. So you had a bunch of analysts coming out. Arete Research Services lifted its rating on Baidu's American ADRs to buy from sell. It had held the only sell recommendation on the stock since it downgraded it last May. So this one and a bunch of other analysts coming out and weighing in. Everybody's looking at me. I'm a little nervous.
No, you're good.
Okay.
I just feel bad about Krispy Kreme.
Okay, we're going to get to Krispy Kreme. Let's go there.
And by everybody, you meant
this is this is Tim moving me along. Stock was up about 11.5%
That's why I feel bad.
Session.
That's why I feel bad.
Still eking out a gain, but not even a 1 full percentage point.
I'm sorry, Carol.
I
convinced her to do it, Romain. I said, you got to do.
No, this is a big
Krispy Kreme.
story. Yeah.
I know it was a big story.
Absolutely.
FBI
So what's the deal now? The FBI director, what is he? Is he like taking over Krispy Kreme? What's happening?
No, he's got a day job already, and he's also been pretty busy, answering questions from members of Congress. The FBI director, Kash Patel, questioned by one representative before the House Judiciary Committee about stock purchases from a disclosure form he signed in July. He was asked about the transactions, including one in a national coffee house chain, that would be this one, and also one in a semiconductor company. On Semiconductor was on the move too, but yeah, I thought we'd highlight this one.
And just two quick honorable mentions. Just want to point out PayPal popping about 3% on that partnership with Google. And, of course, Lyft now at its highest level since 2022, Carol, on news here of that partnership with Waymo.
I'm glad you did Lyft, because now I can talk about Uber. It was the second biggest decliner in the S&P 500.
We didn't even plan this out.
We didn't. We didn't. Down 5% today.
You guys were on TV together this earlier. I'm sure you planned a lot of stuff.
As Romain mentioned, Lyft is partnering with Waymo to offer robo-taxi service in Nashville starting next year. It may sound kind of familiar because Uber has a lot of these deals already. This one is the first one between Waymo and Lyft. Waymo is already an established partner with Uber. These two companies have struck multi-year deals. Back in 2023, Uber now offers Waymo trips in Phoenix, Austin, and Atlanta. So Uber declining on the news that Lyft is now playing with Waymo as well. Also, not all IPOs in the last few weeks doing stellar. Look at StubHub today. Actually fell 6.4% in its debut, falling below the IPO after the ticketing platform raised $800 million in its IPO. The company sold 34 million shares at $23.50, and its market value is about $8.5 billion. That's based on the outstanding shares listed in its earlier findings. And finally, General Mills falling today by 0.8%. Even though the company reported adjusted earnings per share for the fiscal first quarter that topped estimates.
I just want to point out, you mentioned StubHub falling below its IPO price. We should point out Gemini Space, which went public last week at $28 a share, opened at $37, closing below that $28 price at 24 and change here on this Wednesday afternoon. We are expecting some earnings, I believe, out of Cracker Barrel. They are crossing the wire right now. Let's take a look. Of course, a company that has been in the spotlight mainly for political and cultural war reasons. Well, this is a bottom line story, and the bottom line is a miss. 74 cents a share in the most recent quarter. The street was looking for 76 cents a share. The revenue did come in above estimates at about $868 million. Here's the company's guidance going forward for 2026, which is basically the fiscal year that they are in right now. They say that revenue will be in a range of $3.35 to $3.45 billion. The high end of that range below the average of analyst estimates of $3.52 billion.
All right, I'm looking through the press release, and yes, there is commentary on the logo controversy. It's the first thing, and pretty much the only thing that's mentioned at the top. Julie Masino, the company's president and CEO, said, quote, "We thank our guests for sharing their voices and their passion for Cracker Barrel in recent weeks, and we've listened, switching back to our old-timer logo, hitting pause on remodels and placing even bigger emphasis in the kitchen and other areas that enhance the guest experience. Many elements of our plan are working well and delivering results."
Well, I got to say, this is a stock
nightmare is over.
That is heavily shorted. About 25% of the float is shorted. So on any, you'll see some activity maybe coming off of these earnings, that's for sure.
All right. We'll keep an eye on that. We should point out those shares are still slipping here. And really just a reminder, of course, as some of these companies get caught up in the culture wars, we turn back to what's going on in the macro environment. And you're taking a look at yields right now, which are higher across the board. Remember, we came into today with yields moving lower. They actually moved lower on the back of that 2 p.m. announcement by the Fed about cutting rates. But once Jay Powell got to talking and people started assessing what Jay Powell had to say, you did see yields push higher. We should point out, though, at those levels, 3.5 on the 2-year yield and roughly about 4% on the 10-year yield. That's still materially lower than where we were just a few months ago.
Have you ever been to a Cracker Barrel?
Yes.
Oh, okay. A lot?
I've been to them. Yeah, I have no comment.
Okay. Oh, okay.
Yeah.
All right. That feels a little chilly. Okay. All right. We're going to leave it there. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. Remain continuing there on the close on Bloomberg Television. Tim and I continuing right here on Bloomberg Business Week Daily.
And our coverage does continue here on Bloomberg Television. A deeper dive into the Fed's decision that just passed, and more importantly, what the path ahead looks like. Alan Blinder are going to be joining us, former vice chair over at the Fed, when we come back. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close here on this September 17th, 2025. It was 1 year ago today, 364 days ago, actually, to be precise, when the Federal Reserve lowered its benchmark interest rate by a half percentage point in what was an aggressive start to what was supposed to be a prolonged policy shift. Jay Powell that day said the decision reflected growing confidence that monetary policy could maintain strength in the labor market while allowing inflation to move sustainably down to 2%. That was a year ago. Core PCE, the Fed's preferred measure of inflation, was hovering around 2.7%. Today, it's higher, hovering around 2.9%. The labor market a year ago was adding about 100,000 jobs each period on a 3-month rolling basis. Today, it's weaker, a trend line of less than 30,000 job additions. When investors questioned back in January why the Fed had paused its rate cuts after just 3 meetings, Powell said the FOMC needed time to evaluate how Trump's policies on immigration, on tariffs, and taxes affected the economy.
I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to, to the much lower level of job creation and other evidence of softening in the labor market.
So here we are, 8 months later. The Fed has ostensibly resumed that rate cutting cycle with a quarter-point cut today and a dot plot that shows 2 more cuts by year end and at least 1 for 2026. That last note on 2026 is a big part of why markets ended where they did. At 2 p.m., we did see a rally in risk assets, but once people started parsing the dot plot and started parsing what Jay Powell had to say, stocks flipped back with the S&P, the NASDAQ ending in the red, and a 2% rally in the Russell being almost entirely erased. Joining us right now to talk a little bit more about the Fed's decision and what the next step is, Alan Blinder joins us right now, Princeton University professor and, of course, the former vice chair over at the Federal Reserve. And, Alan, I do want to go back to the start of this year when the Fed effectively had said it was on pause. It needed time to kind of look at the data, look at the impact of policies coming out of the White House and Congress on the economy. It looks like, as of today, Jay Powell seems to have a better read on that. And it does not seem to suggest some of the worst case scenarios, at least that the market has started to price in earlier this year.
That's right. Well, I don't have to tell you, you know very well that markets tend to exaggerate everything. So most of us economists didn't think the effects of the tariffs would be gigantic, even though we were against them, as I was, and almost all economists were. I don't think that's been tremendously surprising in that regard, although probably slower than a lot of people thought. And the Fed's judgment now, as Powell expressed today in the press conference, is that the risk to maximum employment, that's one part of their dual mandate, look greater than the risk to low inflation, the other part of their mandate. It was a judgment call. You could imagine it going the other way. But by the time we got down to the verge of the FOMC meeting, the markets were completely convinced that it was going to be 25 basis points down. So there was no surprise there.
I am curious, just historically, Alan, I mean, as an economist, we talk about this dual mandate. Is the general sense amongst economists that a weaker labor market is potentially much more damaging to the economy than high inflation, or is it the reverse?
I don't think it's either, actually. I think the notion that there should be a dual mandate in the United States, by the way, this is not normal around the world, but the notion in the United States or among American economists is that both parts of the dual mandate are important. And one of the things that guides the Fed's decision maker is which one looks more in jeopardy at any one moment. Sometimes neither one looks in jeopardy, and the Fed's not going to do anything under those circumstances, which is the way it looked for some months. But sometimes it looks like one is more in jeopardy than the other, then that calls for an action. And that was the Fed's interpretation today, which I agree with, by the way.
You do. Well, what do you think, though, about kind of the projection on the dot plots? I mean, basically telegraphing to the market, at least based on the survey responses, the idea that they are willing to cut at the next 2 meetings and at some point in early 2026. Based on the data and based on what we know now about the economy, does that seem appropriate?
Well, maybe. Now, you said the next 2 meetings, but one of those is a coin flip. The markets seem only to want to look at the median. But I think one of them was like 10-9 or something like that. So, yeah, there could be 2 more cuts this year. There could be only 1 more. There could be more if things deteriorate in ways that are not now expected. I thought it was notable that Mr. Myron's dot, we assume that's him, was way out of line with everybody else's.
Yeah, well, yeah, and some of us might have actually assumed that. It is kind of interesting, too. I mean, we kind of knew that at least potentially he would be the outlier here. But it also raises the question about what the debate looks like at the next 2 meetings. It almost seems like today was an easier call. I don't want to say it was easy, but it was certainly easier than maybe what the next couple of meetings are going to look like. And I do want to just focus in on a second, Alan, on where inflation is relative to the 2%-ish target, and whether the Fed is maybe just comfortable, at least for right now, in near 3% rate on the core PCE.
Well, that's a good question. They're not talking like they're comfortable. Every time they talk about inflation, they say it's too high. But you could make the case, as I think you just did, that they're acting like they're comfortable. They're not showing any urgency of moving the inflation rate down from nearly 3 to, say, 2. The forecast has it going there in 2 more years. And they seem content with that.
I'm curious, do you have an explanation, just in your own personal view, as to why we didn't see a more meaningful drop in inflation? Like, kind of once we got down to that 4%, sub 4% range, it kind of like we just kind of stalled out. And I am curious as to what sort of arrested that decline.
Well, I think so. A couple of things. First of all, the amount of slack in the economy was never that large, and it's slack in the economy that basically pulls the inflation down. Secondly, during the last part of the Biden administration and the first couple of months, I think, if I got the timing right, of the Trump administration, the inflation rate was creeping down slowly, as you'd expect, with very little slack, no recession or anything like that. But it was creeping down, and then it stopped creeping down, and has now lately been creeping up ever so slightly. Most of us think it's the tariffs. The tariffs are a stagflationary shock. Every sensible person thought they would push up prices, not down. And I think they are pushing up prices. But as I indicated a little while ago, not dramatically. It's not like these tariffs were going to push the inflation rate up to 4, 5, 6%. No sensible person thought that.
Do we need, though, something to break effectively in order to get us back down, meaning that they would have to either reverse this decision today and start raising rates and hurt the economy, or maybe that stagflation scenario does play out? I mean, what traditionally would get us back down to that 2% level?
Yeah, slack. And I think what the Fed is expecting, they didn't quite say this, but it's sort of implicit in what Powell said and in the forecast, that gradually increasing slack in the labor market, which is what they're worried about, is the main way that inflation is going to fall. And so they feel a little more confident that inflation will fall, and a little less confident that we're going to maintain an unemployment rate as low as it's been lately.
All right, Alan, really appreciate it, as always. Professor Alan Blinder over at Princeton University and a former vice chair over at the Federal Reserve, as we continue to parse the market moves of the day and look ahead to what comes next. An extraordinary meeting that was kind of, well, overshadowed quite a bit by the potential politics surrounding it. When we come back, we're going to have that discussion as President Trump tries to remake the Fed, and that could be a big story as we head into 2026. Libby Cantrill over at Pimco. She joins us after the break. This is The Close on Bloomberg. All right, well, there was a lot of intrigue heading into today's Fed meeting, an 11-1 decision to cut interest rates. But all the focus, at least some of the focus, I should say, were on 2 members of that committee. Trump favorite Stephen Myron, just sworn in just a day ago, was at that meeting. And, of course, he did vote, actually dissenting, I should say, hoping for a 50 basis point cut. Meanwhile, Fed Governor Lisa Cook, who had been on the hot seat for the last few weeks, towing the line pretty much as to where the market expected. A lot of questions, though, going forward about what comes next for the Fed. Pimco Managing Director and Head of Public Policy, Libby Cantrill, joins us right now. And Libby, I do want to start off with the reshaping of this. This is going to be a different Fed in a few months' time, one way or the other. We know Powell is going to leave at some point. Trump has got Myron there, and we know that whoever Trump picks next to fill Powell's shoes or any of the other potential open positions, likely, I would assume, would have to be in more of a dovish rate camp.
Yeah, so a couple of things that were surprising to us. And when we actually had expected that this Fed would likely guide to 3 cuts by the end of the year. So that was what we had been telling our clients, just based on sort of the payroll data and other economic indicators. But 2 things that were sort of interesting from this meeting, sort of to your point about personnel. One was, of course, that it was only Myron who dissented. That was, I think, expected, that should he get confirmed and sworn in by the time of this meeting, that he would likely dissent and advocate for a bigger rate cut, but also that, Chris Waller and Mickey Bowman did not dissent. They, of course, had dissented back in June. I think the expectation was that they probably would be also advocating for a bigger rate cut. So that was quite interesting. But as it relates to sort of the future composition of the Fed, you were right, of course, that Chair Powell's term is going to be up at the end of May as chairman. Of course, as you know, he can still remain on the Fed, though, until January of 2028, because he can sit there as governor. Yeah. But presumably anybody who's going to be nominated is going to have a more dovish view in terms of getting the nomination for the president. But one really important point here that we've really been emphasizing to clients is that, of course, nomination is the first step, but you also have to get confirmed by the Senate. So that's going to be a balancing act for whomever is actually considered to be the next chair.
Yeah, and it's kind of weird you think about it. That's still about 8 months or so away before Powell's term is up. And Powell talked a lot today here about what's next for the Fed and the idea that he wants to be patient, he wants to go slow, he wants to be dependent on the data. Data, as you know, Libby, that's been in question over the last few months, primarily by the Trump administration.
Yeah, that's exactly right. I mean, this also goes back to the BLS director and the firing of her and who will replace her. Again, that is also a position that is subject to Senate confirmation, and the person that President Trump has sort of envisioned may not actually get confirmed. Our economists always emphasize that while an independent Fed, of course, is critical for the functioning of capital markets and the general integrity of those markets, independent data is just as critical, if not more so. So, in fact, within the walls of Pimco, we put as much emphasis on the importance of an independent Fed as we do of independent BLS. And of course, that's a little bit more nuanced, but you're right, that is just critical.
One sort of potential speed bump in all this is, and I was just reminded of this just last week, is apparently we don't have a budget in this country. I don't think we've had really a budget for the most part for the last couple of decades. But this is something, in all seriousness, that the House and the Senate are going to have to address. Otherwise, we're apparently staring at a government shutdown within the next week.
Yeah, and I think this is really important, and it ties back to the Fed outlook for the economy as well, because should the government shut down, and you're right, Congress needs to come together, the House and the Senate needs to come together to pass a funding bill by September 30th. If they fail to do that, the government will shut down. But if the government does shut down, if they fail to reach that consensus, then there could not be a catalyst to reopen the government. And I think that is something that we're considering here, that the longest full government shutdown in history was 16 days. That was back in 2013. There were indications that did impact the real economy. Not only would it impact the real economy, but it also could impact data, to our previous conversation, just in terms of the BLS and the BEA actually being able to conduct their surveys during a government shutdown. So I think this could be sort of a headwind from an economic perspective, and obviously could inform the Fed's decision when they meet back in October.
All right. Well, definitely food for thought there. Libby, always great to have you. Libby Cantrill, Pimco Managing Director and Head of Public Policy, as we continue to parse what comes next after the Fed rate cut today. We did see a big bid come into bank stocks. In fact, the KBW Bank Index closing at a record high here on the day. Of course, all coming just about a month before we get the next round of earnings out of that cohort. A conversation up ahead with Chris McGratty, Head of U.S. Bank Research over at KBW, and what this rate cut means for the broader banking sector.
Tension the Fed has to deal with, and you've been picking at it all day, is the tension between a higher inflation rate and ultimately where Fed funds could settle in at. People have to keep in mind, the growth rate in the economy was brought down, and now it's starting to go back up. So next year is predicted to be better than this year, and the year after is better than that.
The Chairman and CEO of Bank of America, Brian Moynihan, speaking a little bit earlier here on Bloomberg, discussing that tension that the Fed has to deal with. A lot of talk right now about the impact of today's Fed decision and the rate cuts that they're projecting going forward. Joining us right now to talk a little bit about what this means for the banking sector is Chris McGratty, Head of U.S. Bank Research over at KBW, a Stifel company. And Chris, taking today's rate cut, and if you believe what's on the dot plot, potentially by the middle of next year, we'll be at least a full percentage point lower on the Fed's fund rates than where we were just yesterday. Is that going to be a net positive for banks?
Well, thanks for having me back. I think the expectation today versus yesterday, nothing materially has changed. We're still in a pretty healthy economy. Yes, inflation's a little bit above the Fed's targets, but they are concerned about employment. So this dual mandate is a challenging exercise for the Fed to solve. From our seat, the economy is in pretty good shape, right? We think earnings growth for the banks is set to accelerate. These rate cuts, we believe, will continue the positive earnings momentum that's in place for your traditional banks, and it's also going to keep capital markets pretty healthy.
It keeps capital markets pretty healthy. That's something that Brian Moynihan himself talked about. We also heard a little bit earlier today on another news outlet, Jamie Dimon also talking about the business at J.P. Morgan. The big banks are going to do well, but they've been doing well, Chris. The big question is, what about the rest of the banks out there, the small, the regional banks? What comes of them?
Right. To your point, the largest banks have been winning. We think they'll continue to win. We think the scale and the consistency and the deregulatory narrative that's playing out, there's a lot of momentum there, and we like the universal banks. For the regional banks, for your average bank in America, the earnings profile and the earnings outlook is pretty healthy. Credit costs are pretty contained and benign. We are seeing pockets of loan growth, and we are seeing margin expand. So if rates come down, and if rates come down for the right reason, that's the debate we're having. Are they cutting out of conservatism or optimism? If rates come down for the right reason, you could get a pretty good narrative for the average traditional bank.
But are we talking about sort of a pickup in lending activity? Because we don't hear that a whole lot from those banks, nor even the big money center banks. It's all about trading revenue, investment banking fees, et cetera.
Right. The mainstream bank in America, commercial and industrial lending is really what we're looking for. We're seeing companies put more capital to work, but we have to keep in mind there was a lot of uncertainty in the beginning of the year with Liberation Day. As the consistency is, the volatility has been pulled out of markets, banks and investors can make decisions for multi-year purposes. And I think what you're seeing is the second quarter was pretty good from a loan growth perspective. We heard updates from the banks last week. That's continuing. It's not robust, but it is moving in the right direction.
So I am curious, just in terms of like your top ideas, Chris. I mean, let's just start with some of those big banks, like a Bank of America, like a J.P. Morgan, like a Citi. You still favor those as buys?
Those three are three of our top picks. I think they're for different reasons, right? If you go at the far right end of the spectrum, you have J.P. Morgan. I'd throw in Morgan Stanley as well. Best-in-class returns, most consistent ROEs in the space, and the capital that's being freed up from deregulation is pretty powerful. At the other end of the spectrum, Citi is our deep value idea. It's trading at book value. When you can buy back your stock at book value and really the importance of that can be pretty powerful as the company gets to that 10 to 11% ROE target. And then wedged in the middle is Bank of America. Bank of America trades at 11 times earnings. They're going to produce a 15% return on equity this year. And what we think is interesting for B of A is they've recently announced an investor day in November, and they haven't hosted one in as far as we can go back. We think there's a story to be told there, help recontrol the narrative of that responsible growth strategy that Brian's been talking about.
What about regional banks? Anything you're looking at there?
Sure, I would say we're selectively constructive on the regionals. One name that I think can benefit from the capital markets, but also the loan growth, so you kind of get that dual-pronged approach, is Citizens Financial. Right, Citizens is in the process of a multi-year return on equity improvement to the tune of 300-400 basis points. So simply the passage of time will create much stronger returns for investors. At the same time, loan growth's improving a little bit, and they've also got, with JMP, they've got a capital markets play. So you can kind of play both ends of the thesis with Citizens, and the stock trades for 10 times earnings. We think that's really attractive.
All right, Chris, always great stuff. Chris McGratty, head of U.S. Bank Research at KBW, a Stifel company. Here on this Wednesday afternoon, a focus on the macro, but let's take a look at some of the individual stocks that did post some pretty decent gains during the cash session earlier today. Lyft, one of the biggest gainers out there, up 13% on the back of that partnership with Waymo for autonomous robo-taxis, I should say, in Nashville, Tennessee. Workday getting a nice bid as Elliott takes a stake in that company, and PayPal in partnership with Google, giving that stock a pop of about 3%. Meanwhile, we did see some weakness in the tech space. Broadcom, Nvidia, and some of their other chip stocks moving lower here on the day as a lot of people rotate around the market. And just now here in the after-hour session, we're seeing a little bit of a dip in the steelmaker Nucor, down about 4% in the after-hours trade. The company appears to be making a pre-announcement here on its third quarter earnings. It's scheduled to report earnings until October. It does say that 3Q EPS will be in a range of $2.05 to $2.15 a share. The street was looking for $2.59. The company says it's decreasing its earnings estimates across all three of its operating segments. We're going to have to dive a little bit deeper to get you a reason for that here, but something to keep an eye on. We'll be back. This is The Close on Bloomberg. All right, with the Fed's interest rates coming down 25 basis points today and maybe even more over the next few months and quarters, a lot of people are taking a look at tech stocks. They're really taking a look at the Mag 7 and saying, is there anything else out there? Well, our next guest says that quietly there has been a group of profitable stocks that have been beating the Mag 7 for quite some time in the Russell 1000, outpacing the Mag 7 in 6 of the past 8 quarters. An eclectic group of names that includes Broadcom, Carvana, Tapestry. Chris Cain joins us right now with that research, quantitative equity strategist over at Bloomberg Intelligence. And Chris, this report you guys did this morning, you and Jillian, really caught my eye because I guess I kind of felt that this was going on, but you really quantified it. So explain exactly what is outperforming.
Sure. So, you always hear this market is just driven by the Mag 7. And of course, that's a big part of it, but the devil's in the details there. So we wanted to see how many stocks of the Russell 1000 have consistently beat the Mag 7 over the last 2 years. So not just total return. We don't just want, one stock that jumped a lot in a day or a week. So we looked at how many stocks have outperformed the Mag 7 in 6 of the last 8 quarters. Only 32 stocks of the 1000 have done that. So it's a pretty exclusive list. Only 6 have done it in 7 of the last 8 quarters, and actually none have done 8 of 8. So, when you look at these stocks, I look at things through a factor lens, and I want to see, what are the common characteristics of these stocks. So some of the commonalities, like you said, high profitability. So I don't mean their stock returned a lot. I mean things like high return on equity, high return on invested capital, high margins, very expensive. A lot of these stocks are very expensive and very high betas or very high sensitivity to the markets. Those are kind of the common factor attributes.
I am curious as when we start to talk about sort of the complexion of those names and what rate cuts or the start of a rate cutting cycle, if this is indeed one, what it means for those names.
Yeah, I think the market generally is just really set up really well here, Romaine. I mean, like I mentioned on Friday, if you remember, stocks do very well in cutting cycles, about 15% annualized when you go back to the 1970s. And if we have a cutting cycle with no recession, which the Fed seems to think we are going to, that jumps to 25%. So, you do see in those rallies a lot of high growth areas, expensive stocks, high beta stocks do very well. Again, those are the commonalities of the stocks that have beat the Mag 7. So I think we can see a continuation of that. It's not the best news for value investors, maybe, but we see a continuation.
Chris Cain, quantitative equity strategist over at Bloomberg Intelligence. Some great research on the Bloomberg terminal, as I think everybody now is trying to figure out what this rate cutting cycle actually means for stocks going forward. We did get a bit of a pullback today, but it's hard to really judge where things go based on the knee-jerk reaction on Fed Day. Our next guest says that, well, this rate cut is the start of another leg to the tech bull cycle. Dan Ives joins us right now, Global Head of Technology Research at Wedbush Securities. Dan, all right, lay it out for us.
It's a bright green light.
Yeah.
I mean, for tech, because to me, it's like, think about it, you got AI revolution hitting its next stage of growth. We've seen that with Oracle, NVIDIA, and across the rest of tech. Now you got a cut cycle. In my opinion, this is really going to turbocharge this tech rally. And it's not just about Mag 7.
Yeah.
It's about second, third, fourth derivatives.
Yeah.
I think tech stocks could be up another 10% between now and the rest of the year.
Is that more of a sentiment issue, the idea that with the Fed being more accommodative, or is this really about like cost of capital? Because I would assume a lot of these people in the tech space, these companies in the tech space aren't really borrowing.
Well, I think that's part of it. I mean, this is and guess what they're going to spend on? AI, data centers. So it speaks to our view. Like, look, tech's had a strong year so far. But it's get the popcorn out. I mean, this is still, we've talked about it, it's only 10:15, 10:30 p.m. in that party that goes to 4 a.m., started at 9 p.m. a year ago. And you look at software, it's chips. You look at now the data center side, the power side, names like GE Vernova and others. I mean, that to me is the most exciting. It's about the second, third, fourth derivative is playing out across tech.
And we kind of started to see that, particularly based on what we saw out of this earnings period. I mean, Oracle was really kind of, I don't I won't say it surprised everyone, but it was certainly the punctuation mark and the idea that it is broadening out. We were talking the other day about how Corning was, up for like 11 straight days. And you have all these stocks that were kind of either forgotten or not really considered to be part of that tech AI trade that now are getting a lot more attention.
Well, I think it's a great point, because that's now the focus. Because investors, they're looking to see, okay, who now is going to benefit small cap, mid cap, software, across chips, because there's just further validation that this AI revolution is hitting this next stage of growth. Use cases are exploding. Look what's happened on the consumer side as well. CapEx continues to be rock solid. And I think as that plays out in a cut cycle, look, I just think tech, it's in the left lane in a Ferrari going 100 miles an hour. And I think that, look, there's going to be speed bumps along the way. Yeah. But just like we saw with NVIDIA, China News, and others, I just view those as bark worse than the bite, because this now is the start, I think, the next leg of the bull cycle.
Well, I do want to ask you about that, because I think markets did get a little rattled by the news earlier this week about China, potentially, basically saying you can't sell here for right now. And I know there's discussions going on at a high level between the U.S. and China that may resolve that. But when you look at these U.S. companies, what's the valuation look like if China is not a place where they can sell? Because we've all seen NVIDIA's inventory. Sure. They got it. They can sell it if China allows them or the U.S. allows them, but they can't do it right now.
Yeah, and look, I think this is all a game of high-stakes poker, too. Between U.S. and China, what's the biggest poker chip? It's NVIDIA. Look, and I think the street is not factoring in full sort of demand cycle into China. So my view is that as this starts to, I think, play out, you will continue to see more and more selling into China. Look, Beijing clearly shots across the bow in terms of how this all plays out, but I don't think that's actually factored in. And I just think my view is whenever you have this type of news, it's very easy to kind of yell fire in a crowded theater. I just don't think that's the right way to view it. You got to look at these are the opportunities. I think NVIDIA is a $5 trillion market cap. And there's only one chip in the world fueling the AI revolution. That's NVIDIA.
I am curious about what opportunities they have in overseas sales. Just today, Trump is in the UK. There's been a lot of talk about some potential investments to help build out the Britain's AI infrastructure, which is a minuscule compared to what we have here in the U.S. And if they want to build it out, they most likely would have to be dependent on U.S. companies.
Yeah, look, it's a land grab. I mean, look what's happened in the Middle East, right? That's why, Jen's wearing this black leather jacket. Come look at Car Palantir and others, because now you have an arms race playing out. And U.S. I think Trump administration recognizes this is the opportunity for U.S. tech to get bigger. And that's something, when you talk about what's not factored into numbers, it's about rest of the world. Because remember, we're only 3% through in terms of where this all is trending from an AI perspective. And that's why, look, the bears, when they're in hibernation mode, they can see AI in the spreadsheets.
I'm curious, Dan. I mean, I know I've always been relatively optimistic in this space, at least in this cycle here. I mean, what is the biggest risk, though, that you have sort of just on your radar?
Look, the biggest risk is clearly China, U.S., if that actually goes south. But our view is that's actually getting more and more potentially positive as we see those negotiations. And it's a pay-for-play model. Big tech is adjusting to that. You saw Cook, he's playing nice in the sandbox in terms of, in the White House. And that's important because now we're going to see, I think, going into the rest of the year, I think this is really going to be the next leg of this tech bull market, which we think is on for the next 2 to 3 years, given with this fourth industrial revolution playing out.
But also part of this tech trade, it is more than just AI. Obviously, we talk a lot about autonomous driving, robotics, and just overall, just sort of the facilitation of more tech in our lives. Outside of the pure play sort of AI trades, where is the other big opportunity that you
Look, I think clearly we talk about autonomy in terms of physical AI. That's what Tesla, to me, along with NVIDIA, the two best physical AI plays. But then you think on the infrastructure side, you got CoreWeave, Nebusis. You look at GE Vernova on the power side. Akko is another example of it. So what
about quantum computing?
Look, and I think quantum, you have to put it. You have to factor that in. And I think now what's starting to play out is that the technology wave is just accelerating. And now with Fed cutting, to me, that's a bright green light for more money to come, off the sidelines into tech. And I think that's really good for the bulls going into year end.
All right, Dan, always a pleasure.
Great, thank you.
Dan Ives, Managing Director and Global Head of Technology Research over at Wedbush Securities. All right, we do want to stick in the tech space and specifically on Tesla. Some breaking news just in the last hour. We've learned that the EV maker is redesigning its door handles over safety concerns that Bloomberg had reported about just a little while ago. Take a listen.
We actually have a mechanical release that's, basically right at the electronic one too, and we're combining the two. So, in the moment that you're in a panic situation, the muscle memory to go to, what is right there. So you just pull a little bit further on the lever and you have the mechanical release. So that's something that we're working on, yeah. And it's in the cars now.
An interview there with Tesla's longtime design chief, and one of the folks who helped to do that interview is Matt Miller, the co-host of Hot Pursuit, as well as Open Interest here on Bloomberg Television. All right, Matt, this is a very serious story, and it's something that Bloomberg's been tracking for a while. What was his response today about the safety of the models as they stand right now?
Yeah, I mean, he was not defensive when I asked him about this, which, it was a pretty hard story that Businessweek wrote about him, where people actually lost lives or were maimed because of, in part, these door handles that are difficult to open. Certainly, if the battery goes out from the inside, they're impossible to open, and from the outside, usually first responders had to break the window. I think it was interesting that he immediately said, look, we want to find a solution to this. Mm-hmm. We want to work so that no one else is hurt. And basically, they have come up with a new mechanism so that it's a button where you push it and it works electronically. But if you panic and push it harder, it operates a mechanical device that opens the door.
So I just want to be clear, and I want to be careful about this here. Was this a defect, or was the way that this was designed basically meant to work as it works?
Yeah, no, it wasn't. It's not a defect, and many cars have this. For example, I got stuck in a brand new Corvette a few months ago in our parking garage downstairs because the electricity to the door handle went out. Mm-hmm. And it wasn't until a garage attendant pointed to a mechanical lever on the floor that I was able to exit. A lot of different car makers have this kind of mechanism, but obviously if you're in a panic, especially if, as Hannah points out, Hannah Elliott, my co-host who booked this interview, if you're a child, you're not going to remember that the alternative door latch is under the carpet in the rear seat. Yeah. So
and not just remember. I mean, I think it's been pointed out that a lot of people don't even know. I mean, a lot of people who buy cars they aren't as well versed in how a car is set up like you are. They just buy it. They just think you pull the handle, you open the door, and that's it.
No, absolutely. Yeah. So if the battery dies on a Tesla or on many other cars, you can't operate the electric device that opens the door from the inside. A bigger problem maybe is that on the outside of a Tesla and a number of other cars as well, the door handle goes flat while you're operating the vehicle, and it only comes out so that you can open the door from the outside if the electricity is still running. So if you get into an accident that disconnects the battery somehow, or if your battery dies, as happened to somebody in the story that Businessweek wrote who had a 2-year-old in the child seat, there's no way to get it open without breaking the window.
I am curious as to why there was so much attention on the incidents with Tesla vehicles. Were there other incidents involving non-Tesla vehicles of a similar nature?
I mean, there have been other incidents, but in none of the cars that I know of, you have both the electronic-only button on the inside, and to be clear, Teslas all have a latch somewhere, and also the flat door handles on the outside. So that's one of the big concerns, at least across an entire brand offering. There's nothing like that. Tesla is the only company that in the U.S. that offers that on every single model.
And just to be clear, just to wrap this up, so new models as they come off the assembly line.
Yeah,
what are those doors going to look like?
That's what Franz told us. So it's not clear that they'll change the exterior door handle. Beijing is looking into whether or not they're going to ban flat door handles, but they are going to have an interior button that has basically a dual electronic mechanical operating system.
All right. Matt Miller is, of course, the host of Bloomberg's Open Interest, as well as the podcast Hot Pursuit, the conversation that he had just a little while ago with Tesla's longtime design chief about the potential redesign of door handles on some of those vehicles. We'll be back in a moment. This is The Close on Bloomberg. All right, a busy Wednesday in U.S. markets. Thursday could be even busier. We have earnings before the bell from a key company in the consumer product space, Darden Restaurants, the owner of Olive Garden. And believe it or not, they've actually been doing pretty well. Comp sales, at least the expectations among analysts, expected to grow by about 4.4% on the back of that never-ending Pasta Bowl promotion. Meanwhile, we go back to the macro and a decision over in the UK. The Bank of England set to make a rate decision at 7 a.m. U.S. time. And then back here in the U.S., the data-dependent Fed gets another look at that data. 8:30 a.m. Eastern time, weekly jobless claims, and of course the monthly numbers for the Philly Fed Business Outlook may be providing a little bit more clarity about what comes next. Meanwhile, back in the corporate space, we get earnings out of one of the most consequential companies in the consumer economy, and that is FedEx. Remember, back in June, the company declined to provide full-year guidance, and no one is expecting it to reinstate that guidance tomorrow. We will have full coverage of FedEx earnings when they cross the wire after the bell tomorrow. Lennar also scheduled to report as well. The home builder, a potentially intriguing story given the potential start of a rate-cutting cycle by the Fed. And of course, we keep an eye on the President of the United States, who continues his state visit to the United Kingdom. Today was about pomp and circumstance. We're told tomorrow is going to be a little bit more about substance, about making trade deals and business deals. Full coverage of that all day long right here on Bloomberg.